Hey, what's up, guys? My name's Charlie, and I want to help you build wealth in real estate. Real estate can be a phenomenal investment vehicle if you know what you're doing. The problem is it's really risky and can be extremely confusing. So I'm here to demystify real estate, and I'm here to help you build wealth. Hey guys, welcome back to our show. So today we are going to cover debt service coverage ratio, DSCR. Debt service coverage ratio is something that lenders really look at to make sure a property is healthy and the business plan is healthy. That is, debt service coverage ratio is actually used by companies as well to figure out what their income is minus expenses and what their liabilities are, just to see if a company is healthy. And lenders in the real estate space use that same metric. So what I want to do is go over, I have an example of DSCR and how to figure it out. Every market is different. Properties are different as well, and business plans are different. So I'm going to use a very general rule of thumb here. And this is really just from my experience and what I've seen in the apartment world. If you're looking at buying like an Airbnb property or other rental properties, it could vary slightly, but typically lenders are looking for 1.25 or better DSCR. And we're going to go over that too. In this case, we are looking over here. Let's look over here first. We are looking at a monthly mortgage payment of $1,000. That property rents for $2,000 a month, and there's expenses that are $750 a month. Those expenses could be property management company, landscaping, utilities, whatever it is, but those are the monthly expenses in this example. So we have a net operating income, and if we look down here, net operating income is income, all the income from the property, minus operating expenses. So the NOI on this property is $1,250 for this month. In order to get DSCR, what we do is we look at the NOI, which is right here, and we divide that by the debt service. Debt service is just the mortgage payment, and that's going to be in blue. And what we come up with, this number right here, 1,250 divided by 1,000 is 1.25. So lenders typically look for at least 1.25 or better. And the higher DSCR, the more that the property cash flows, the better cash flow. On this example over here, we're going to use pretty similar numbers. However, the mortgage payment's going to be a little bit higher. And maybe that's due to a rising interest rate. Maybe that's they put less money down or a more expensive property. But in this case, on this side, we are looking at a mortgage payment of, we're looking at a mortgage payment of $1,500 a month, income $2,000 a month, expenses $750 a month, and the net operating income, again, that's the income minus operating expenses. Net operating income is the same. However, when we go to divide these, it's a DSCR of 0.833. That means it's losing money every month because we have the net operating income minus the mortgage payment. Anytime that the number is lower than 1, that means that the property is not cash flowing. Most lenders will not look at this unless there is some extraordinary case. Maybe it's a property that tenants haven't lived there in a while, and it takes a really big rehab budget to do that. Some private money lenders may be okay with that if they have a relationship with the real estate investor. But most financial institutions will not lend to this. In fact, right now, I am seeing that 1.25 is typically the minimum. There's been talks that maybe that will get slightly lowered. But in certain markets and smaller markets, they actually want that to be 1.3 or 1.4, which means in that case, you'd have to pay a lot less or figure out how to increase income or reduce expenses. And so the debt service coverage ratio is really important. Again, it kind of tells the health of the property from a financial standpoint. Is it cash flowing? If so, how much? The lower the DSCR, the more risky the investment is, because if something were to happen, maybe one of the units isn't rented for a long time, this 1.25 can quickly drop. And so most lenders do look for at least 1.25. That means at the end of the month, and what I should probably do here is make this look a little better and show that you always want this net operating income right here. You want the net operating income to be higher than the mortgage payment. So I hope this video really helped. DSCR is really important, especially when interest rates are higher. That can really impact the DSCR. And I've actually found that deals that may have worked a year ago don't work today because the interest rate, the interest rate and interest payment is so much higher today than it was last year, that this might have been a 1.3 or 1.4 last year. And now maybe it doesn't cash flow, or maybe it does just barely, but lenders won't allow you to buy that. So one actually, I'll go back to my screen. One of the ways that you could actually make a property like this work is actually put more money down. So maybe you put more money down and now your mortgage payment is only $900 a month, right? And so you have to put more money down up front, but now it cash flows better, and there's the DSCR is much higher. So now a lender would be fine with that. But if we go back to the previous example, lenders won't be okay with this unless in very, very, very rare instances. But when we put more money down on the property, now they're like, okay, it's much less of a risk, because if something happens and then the income goes down, the expenses go up, the net operating income would come down, mortgage payment would stay the same, but the DSCR is okay because it's much higher. So in order to get a DSCR, to raise the DSCR, you got to look at increasing income and or reducing expenses and or put more money down on the property. So I hope this video helps a little bit about the DSCR. What lenders look for is typically 1.25. That definitely varies. Smaller markets, the DSCR is going to need to be higher. Depending on your business plan, it could be a little bit lower. Sometimes local banks are actually a little bit more friendly, and they just want something that cash flows. It doesn't have to be 1.25, but typically DSCR lenders are looking for 1.25 to get good terms, and the higher the better. Anyway, I hope this helps. Don't forget to like, subscribe, and leave me a comment. Thank you.